So welcome everybody to Strong Valley's mid-quarter roundtable, our second edition here. We're moving our way towards experts. Figured we're only about 1,800 episodes behind Joe Rogan, but we're making progress. I thought we'd start off with a little market recap on what's happened since our last roundtable in quarter two. Obviously, we're in quarter three. And Kyle, you want to talk a little bit about what's happened with stocks and bonds since then?
Yeah, a lot of the things we've been talking about in reviews with clients here, and I'll pull up a slide real quick. It's been a hard year. A lot of people have been focused on the equity markets and kind of not realized on the fixed income side of things that it's actually been the worst year ever to the start of a year for the first 6 months for fixed income. And this is based off of the Barclays Ag here. Again, negative 10% return for bonds, whereas the third worst year for stocks at down around 20% through June. And I know we'll talk about a little bit more kind of how things have bounced back the last few weeks here, but that's made it hard with clients in trying to build portfolios, even in the balance side of things, because, most people are used to the stocks being volatile. But when we have a 10% downturn on bonds, even our 50-50, our kind of our balanced portfolios are struggling too at the start of the year. So that was kind of the thing that jumped out to me the most as far as this year in reviews with clients and markets is it's not just the equities, which is usually what we kind of focus on and clients are aware of. It's even more of our conservative investors that we're having a little rough time the first 6 months of the year.
Yeah, and I know as the market's going today, for the first time I've seen the bonds are actually doing worse. The ag's actually down more than the S&P right now. So bonds definitely haven't been a helper for portfolios like they normally are.
Correct, and those numbers are there through June, and since then, like you said, it's recovered quite a bit. I think now the bonds are down roughly around 9.5% still, so they've come back a little bit, but not nearly as well as the stocks have here. Whereas you get certain indexes down only 9% themselves for the equity side. So,
and then because we invest globally too, international is still down about 15. So really, it hasn't been a lot of good spots to invest this year.
Well, we just got some data in from the end of July, and July was actually the fourth best July ever, behind 1932, 39, and 37. So plus 9.2% for the S&P in July. And it seems to be that how July goes, the rest of the year goes, historically. So, again, historically speaking, we may be in for a really good second half of the year from the stock side. Bonds, maybe, and you're going to talk a little bit about rates, but bonds are probably still in a tough spot for a little bit to come.
Yeah, and then obviously July brings us into our next thing, inflation. Finally got a little bit of a tick down in inflation, which we talked about a little bit last time on the podcast that we thought it might be peaking. Again, you're never sure. You have to see month to month. But July had our first downtick, and you can see from the chart, this is a 20-year chart. So this isn't 6 months or 3 years. Inflation's very high right now relative to what it's been in the past. But you can see at the very end there, just a small tick downward. And we talked about if we get a little bit of inflation relief where investors, the market feels like inflation has peaked and it's going to start moving the other direction, we're not going to see late 70s type inflation, then the market should rally a little bit. And that goes to Chris's point that we've had our best July in a long time.
So I think that's a lot what we said too, just in client conversations that have come up. And I know we hinted at it the last call here, but that was one of the things that we were looking for from a market indicator and just sentiment, like consumers starting to see inflation slow. And some of the meetings we've had the last week, you're not going to see it necessarily at the pump or at the grocery store today. It's not going from, mid 8s all the way down to 3 again, but that downtick is kind of just that positive that it's slowing or coming down. And that's why we've seen a lot of the rally that we have seen the last couple weeks in the markets here.
Yeah. I mean, the thing about inflation too, is it's not obviously normal inflation is a part of society and deflation is actually a bad thing. There are some winners from inflation. And we talked a little bit about winners and losers, and I think it's something that we should bring up. Fixed rate borrowers. If you have a house and you've got a mortgage, obviously that's at a certain rate. Typically, if you're on a 30-year fixed or a 15-year fixed, and then the amount's fixed. So you got two things fixed, and you got dollars, and rates going up. So that's a positive thing. If we're in an inflationary environment, being an existing borrower is a positive thing. Other things, Jason.
Well, I also noticed too is as rates go up for our bond investors, that typically as I kind of described with some clients, being on the escalator is not so much fun. As we see a lot of bonds get repriced. But once we get off on the new floor, a lot of our fixed rate investors, I mean, many of our older clients can remember back in the day when they used to have a 5% CD. And we've been in such a long, drawn out period of time where a CD rate was at, maybe a 0.5% or even less than that. And now we're starting to see some higher rates come through. So for a lot of our fixed income investors, having a little bit of inflation, having some interest rates go up, it's uncomfortable for the moment, but once we get off on a new floor and the rates are higher, the bonds that they own, the bond funds that they own, CDs that they want to own, I've got some clients doing T-bills, things like that. All these rates are starting to pay a little bit nicer returns. So the older days of higher rates on those CDs might be coming back, which I know some people are looking forward to.
Yeah, and for 10 years, it's been challenging for lower risk investors to really generate a return, because obviously if you're lower risk, you're typically more in the fixed income side and you have a little bit of equity, but when your fixed income is paying you next to nothing, it's hard to generate any type of meaningful return for, again, lower risk, maybe older investors.
With the inflation too, the other thing that people need to be mindful of is that anything that's really priced in dollars, whether it's real estate, any kind of land, buildings, stocks, anything that's got a dollar denomination to it is going to be somewhat linked to inflation. If one were to look at the data going back, even on the Dow Jones, you might, or at least I've kind of broken it down with some clients looking at if long-term returns on the stock market, let's say, are going back to 1950, let's say they're 7 or 8%, something like that. I've broken it out in the sense where if the GDP of the country has not averaged close to that rate, but the returns of the stock market have. But if you've broken down the rate of return of the GDP and then you add inflation into it, of a historical inflation rate of, let's say, around 3%, almost 40% of your returns in the stock market have been just from inflation or the dilution of the dollar. And so by holding these assets and kind of avoiding holding cash, whether it's in land, in real estate, in stocks, and something, the inflation should drive up the price of all assets.
Yeah, so dollar denominated assets, income seekers, fixed rate mortgages, fixed rate borrowers, all benefit a little bit from inflation. Obvious losers from inflation.
Cash. I mean, that's one of the conversations we had with clients this year when we're talking about, like I mentioned, with the balanced portfolios and the downward trend we've seen in fixed income this year. It's well, maybe I should just go to cash. And well, obviously we've talked about that a little bit last time about, kind of selling at the bottom and not getting back in. But the other side of it is those people that have held cash, your purchasing power is down 8% this year too. So that's an area where cash, when inflation goes up, costs you more money to buy the same goods essentially. So.
And I think that's the hardest thing about cash. It's one of those things that obviously, you hear cash is king and, cash buys everything, but it also stays, from a visual standpoint, it stays stable. You have $100,000 in the bank, it's still $100,000 plus your tiny bit of interest. You don't see that erosion. You get mad about gas at the pump and you get mad about food prices, but you don't see how that's affecting the value of your cash.
Adam, I often refer to cash because you say you don't see the pain. I kind of refer to it as the carbon monoxide of the investments. It's a safe way to go broke. You feel good. The value is staying the same, so you feel safe. But every single day, it's buying less milk, less fuel, less food, less medicine, less everything. And so, carbon monoxide. Avoid.
Well, that's a good point too, because you mentioned inflation and how high it's been, but even historically, around that 2 to 3%, your cash is always essentially going backwards as far as your purchasing power goes in most market situations.
Yeah, Kyle, the only thing I was going to say is on with consumer price indexes, which is that's really what we measure inflation with, right? The three biggest components to that are real estate, so housing, including rents, which I think a lot of people know rents have been accelerating really quickly the last few years. Food is I guess it's just the third largest, and then transportation is the second largest. So transportation, housing, food and beverages, if you just look at sort of what's happening with interest rates, with the Fed trying to raise rates and hold inflation down, I mean, all three of those things should have some effect just in terms of slowing the growth. And we've already seen housing prices they're not accelerating as fast as they were. People are asking whatever they're asking to sell their house, and they're already having to cut prices. over those sort of wished numbers. And so that just tells you, obviously, mortgage rates are up. Demand for housing is going to be down a little bit, versus how fast it's been growing the last few years.
Yeah. So other losers from inflation. I know we talked about the flip side of borrowing. So if you're a future borrower, inflation's pretty painful. I know in the business side, M&A, mergers and acquisitions activity normally dries up quite a bit once rates start going up, because in order to buy a company, they're typically leveraged buyouts. I won't get into all the details there, but the bottom line is they're borrowing money to buy the company. And when rates go up, that gets a lot more expensive. So it typically drives up M&A activity. Other losers? The only other one I can think of is fixed rate investments. I mean, if you took on a fixed annuity, 2 years ago at 2%, that's going to be fairly painful.
Right.
Obviously, luckily we don't have a lot of people in that situation, but just identifying winners and losers from inflation is pretty important. Chris, why don't you follow up on the what the Fed's done, Fed funds rate since last meeting?
Yeah, well, since our last
roundtable
podcast, I think we've had possibly had 3 raises. I can't remember exactly what the dates were, but so far this year we've had 4 raises. So we had one in March that was a quarter of a percentage point up. Then they raised, following meeting, they raised 50 basis points or 0.5%. Then 2 more rate hikes since then, both at 0.75%, or what we refer to as 75 basis points. So that's 4 so far. From what I'm reading, we're expecting probably at least a couple of more this year. Jason, I think you said what you're reading was they want to come in somewhere around 3.25, 3.5% on the Fed funds rate.
That's definitely the goal. And,
Yep.
I think a good segue or a way to kind of go into this a little bit deeper, a lot of investors are thinking, okay, well, if we know they're going to be raising rates, should we do this, or should we avoid this, or should we get out of this, or should we do that?
Yep.
And the point that I try to make to people is that it's Jerome Powell with the Fed. He's already said exactly what he's wanted to do, and he's pretty good about telegraphing it. And so most of the cake has been baked, and trying to get ahead of something now, the market's already reacted to it. If you look at, the 10-year Treasury, which is a rate that mortgages and so many other investments are pegged against, even though the government has raised rates 3 times, I believe, in the last 3 months, the 10-year Treasury's been flat because it was so telegraphed earlier in the year.
Mm-hmm.
And so that's where, even though there's going to be more rate raises most likely on the horizon, the anticipation by the market is that the Fed may actually start cutting a year from now if the economy does slow down from these rate raises. And so that's at least something to be mindful of, not to try to adjust your portfolio or anticipate something that the market might do when typically it's already ahead of us. Anywhere from 6 to 9 month lead time.
And then lastly, the elephant in the room that always creeps up about this time of year, and you start seeing it on TV and radio and everything else, midterm elections.
Yep.
Kyle, you want to speak to that a little bit?
Yeah, one of the things I've always talked about with clients is, we have clients on all sides of the political spectrum. And so we try to stay politically agnostic with our investments, because it's the markets and the economy that drive that, not necessarily policies. And so one of the things I've always told clients is that, the market's like gridlock, right? So think about it as a business owner. If you had a 5-year business plan, if you had to anticipate change after change, whether it be increase in taxes, reducing of taxes, or whatever that change may be, it's harder to set a 5-year plan. So the market's historically typically like kind of that gridlock in Washington, where there's not one party, Republican or Democrat, controlling all 3 houses of the government. And so that's kind of a positive thing. And I got a slide here, historically speaking, on elections and kind of how they stack up. And for those of you that can't see, but, bottom line is, performance through election cycles is one thing. In election years, whether it be presidential, midterm, non-election, we seem to see historical positive returns. But the area that I think is most important and kind of helps us with what we're in currently is, if we look at the midterm years, we look at the first 6 months of the year versus the last 6 months. And so you can see, historically speaking, right here, that we get, pretty flat returns going into the midterm elections. And a lot of the returns that we see are post the midterm, so the second half of the year. And, I don't want to make any predictions necessarily on where we finish the year, but I think most of us feel that we'll be higher at the end of the year than we are today. And the beginning of the year, the first 6 months were pretty poor. And we're starting to see that kind of turn around right now, which is, kind of hinting at what we've seen historically here with the election years, especially focusing on the midterms in this case.
Yeah, and you combine that with what we were talking about earlier with, how goes July, how goes the rest of the year. Really strong July. Average return for last 5 months following a positive July is a little over 6.5%. And that we're just talking about history since 1926. So again, nothing. We're not trying to predict the future. We're just sort of trying to use history to help us as a guide. So
that creates a pretty good market picture of what's happened since the last roundtable. One thing we like to do, and I guess I say we like to do all of our second time here, but we got a lot of good feedback on it from last time, is questions from clients. Because this is one of those things where, we got one client or two or three clients asking the question to one or multiple of us, but there's another 10, 20, 30 people that have the same question that just didn't ask it. So what are you guys hearing? Top questions you're getting from people that you're talking to?
Well, I'll kick it off here. I mean, I think we've hinted at a lot of it with the inflation talk, because that has been the forefront for most of our conversations over the last, handful of months here, and it's taken up most of the airways. But the other that we haven't really talked about yet that came up quite a bit is the R word here, the recession. So not going to get into the politics of how to define a recession and those definitions that seem to move around and change. But more focus on, the markets themselves and historical recessions. In fact, I kind of got a slide, and this is something I've been using recently in client meetings is you hear us say that markets are leading indicators. And what I mean by that is typically when the news hits, Adam, you hit on it just a minute ago with, the advertising adjacent of the Fed knowing what they're going to do on these rates. And so those things get priced into the market. The market figures that out. They're not just sitting there waiting for things to happen. They're looking ahead. And so historically speaking, usually when we get into a recession, a lot of the downside of the negative impact that we experience in the markets has already occurred. And so what this slide's showing you essentially is over the last handful of recessions, going all the way back, how the market's done during the recession. The average annual return is around -1%. Now, obviously, we've had 2007 where we're down 37%. And that can be the case during. But, you look at the 6 months before and the 6 months after, same with the 12. A lot of that happens negatively before, whereas the 6 months following and 12 months after recession is where we start to see that positive returns. And so historically speaking, that 6 months after a recession is around 7%, and 16 if we look at it for 12 months out. So, and then if we look at for a full 2 years, it's historically speaking, the average is around the 20% positive return. Mm-hmm. And average wise, those are over, 80 and 90% of the time. Now, granted, we haven't had 50 recessions. So, but that's just kind of what we've seen, is that a lot of times we hear the news and the talk about a recession, then the phone starts ringing, or in client meetings, they start saying, hey, should we be selling? We're heading into a recession. And it's like, well, a lot of that's already been baked into the market. And that's why we've kind of experienced what we had on top of what we did with the inflation. So.
Yeah, Kyle, I love that slide. We all get these calls. Everyone's concerned about it. They watch the news, talk about upcoming recession, pending recession. Are we going to be in a recession? And then so a lot of people, no one likes losing money. And so they think, okay, maybe if I can avoid this or sidestep this. But that slide really kind of points out the case that by the time you're hearing it, by the time even the government announces that we are in fact in a recession, most often the bottom markets are in the rearview mirror.
Correct.
So trying to time it, trying to avoid it, it's incredibly difficult.
And I think we hinted at that too last time. And, you have to be right twice, right? You have to be right getting out and right getting back in. So,
and same thing. Again, a lot of our talk last time was it's very, very difficult for the expert investor, let alone the average investor, to front run the market. To be so far ahead and predict exactly what's going to happen and be right on it. Because again, when this data is coming out, or you're hearing it on the news, or whatever your program is, or wherever you're hearing it from, it's already priced in. So that's
I think about this too. I was just talking with someone. It's like I believe in I don't know if it's going to hold as the low, but I think it was June 17th is the current low of the year. There was no catalyst on that day to get back in. There was no news wire, no headline that said, okay, this is most likely the bottom because the government's stepping in, or there's new adjustment. It is. And so trying to guess that and time that would have been very difficult. And if we talked to most of our clients on or around mid-June, there was very little optimism to think, okay, now's a good time to get back in. And so now in hindsight, it looks like it would have been a good time for someone to trade, but But as you just mentioned, it's impossible to guess those dates.
Well, and that same thing there, I actually ran the numbers earlier this morning that it's up over 13% since that low, the market. So again, at what point did you feel good enough to get back in? You know, is it after the first 1%, 2%, 10%?
No.
And most people would still say that all this isn't behind us, and they'd probably still be sitting on the sidelines if they had gone to cash at that point.
Right.
And on that note, I mean, kind of going with our last point with the midterm elections, even now, so more than ever, you're going to hear one side try to tell you, the people that aren't in power are going to tell you how bad everything is and, you know, how it's going to hell. And the people who are in power are going to tell you, no, everything's looking great. So you just got to be very leery of the news cycle. And just, again, that's why we're trying to point out some real factual data and how the market actually works versus hearing people that have an agenda and, you know, and give you some info to act on. Are you guys hearing anything about I-bonds?
Yeah, I'll touch on that. It's a hot buzzword right now. These type of treasuries are saving bonds, rather. These things have been around for a very long time, but they're getting hot again. They're a fun buzzword because of the interest rates that are being advertised. I'll got a slide I'll pop up here that will show some of these facts and figures. The buzz rate, that's catching everybody's ears, is the 9. I think the current rate is a little more than 9.5%. And so obviously, if you can get a guaranteed rate of return at 9.5%, you'd want to put your whole portfolio in it. But here's some of the fine print that normally doesn't make the conversation. So if a person did want to own these, they can't open them up in a Schwab account or a Vanguard account or Fidelity account, et cetera. They've actually got to go to the Treasury Direct. But some other fine print that I think is noteworthy is the maximum investments usually steer people away. $10,000 typically, if you're just going to do electronic, you can throw in another $5,000 if you want to deal with the United States Postal Service. But a $15,000 maximum investment is all you can do per year. The other thing that is caught up in the fine print, most people think if they buy this bond, they're going to get nearly 10% forever. And that's not the case. These I bonds restructure or the rate changes every 6 months based upon the current inflation rate. And so where I'm discussing this with clients, it's like, okay, think about what's happening right now. We're trying to knock inflation down. The Federal Reserve is raising rates in order to knock inflation down. So the rate that you're getting on these bonds theoretically might be the highest that you're going to see the whole time that you own it. And when this thing recalibrates in 6 months, the rate's going to get knocked down. So you're not getting 9.6% forever. You're getting 9.6% annualized, or 4.8 for the next 6 months. Then it will most likely get knocked down, would be my assumption. And it's a 30-year bond. And so you've got this investment now. You can get out of it. But I think if you get out of it within the first 5 years, you're going to lose some interest. I think you're losing about 3 months interest on that. But anyway, it is a hot button. But those are the two keywords that I want people to remember is the amount that you're limited to invest. And then the rate is not set. The rate will adjust.
Jason, when do you think you should be looking at something like this, though? I mean, when is it a good time to be buying something like this? Like, let's say you got a 13-year-old. You think you're going to fund college, right? You need to put a little bit of extra money away. You know, you're going to have it for, let's say, 5 or 6 years. It's not I mean, I would encourage this more than going down to the bank and buying a CD with your $7,000 that you're going to put away for the kids' education for the year.
Agreed.
So,
as of right now, still better than CDs, better than cash.
Yep.
But beyond that, I mean, it kind of depends on the situation, depends on the amount of money, depends on the child, depends on a lot of things. But I agree with you. It still beats cash.
Yeah.
Beats CDs.
Oh, but the flip side of that too, though, is also when
niche
you're looking at
investment.
the longer period of time, like you said, you can get out after a year, 5 years without penalty. But again, you know, if you're looking at, say, 6 month CDs right now, you're pushing over 2.5 to 3%. So you're not giving up that much interest for the annualized rate. And, you know, it's one of those things that you can, you know, matures and you can turn around and look and see what makes sense again versus being kind of tied up into something a little longer.
Well, and we, just to be clear, we don't use these in our investment portfolios because we can't, but also because they're in such small increments that it's hard to move the needle on our typical client. For us to put $10,000 into an account of something isn't enough to really get it done. But again, for folks that have a lot of cash sitting on the sidelines and you got to fund something that's, you know, let's say 5 years out, I think they can be perfect again for smaller smaller dollar amounts.
Right.
So like anything, it's a tool. It's trade-offs. No investment's perfect. Once you know all the fine print, then you can figure out what situation it makes sense. And Chris gave a great example of where it might make sense. But like you said, for most of our clients, adding $10,000 of these, and remember, you got to go direct to the government to do this, which our clients are not really fans of.
Yeah, we've helped a couple people do it, and it's a bit of a hassle. I mean, you spend a lot of time in front of a computer, putting all your information into a website, and that's just a little clunky. But yeah, it can be certainly useful in some spots.
Good. Yeah, I think one of the other questions that I know I've got a few different times is, as portfolios have grown, as people have added money, if they've rolled over 401ks and just generally, increased account value, is, they have a certain risk expectation, but people typically spend in dollars. Nobody really has a risk expectation in percent. I mean, you don't go to the store and pay 2% of your income. You go and you pay what it costs, $100 or $250. So as portfolios have gone up, and now we've hit a rough patch. Now, obviously, we talked about the last month's been good, but for the first 6 months of the year, it was a pretty tough going, and people are looking at portfolios, and maybe your portfolios increased quite a bit, and the dollar value is down a lot more than you would expect. So one of the things that we've tried to do, and we haven't needed it, or I guess it hasn't come up as much in the last several years because markets have been good and most people are pretty comfortable when markets are good. But a tool we use here in the office with all of our clients that we can get to do it is Riskalyze. And it's basically the ability to quantify risk, and not only just quantify it, but put it in terms of dollars. So you kind of got to enter a few pieces of info, and I'm going to, for the people who are just listening, we'll go through this quickly and talk a little bit about it, but just show you kind of how it works and how it's able to put your risk factor in dollars, and then you understand what your range is and where you should expect any portfolio that you're invested in to fall in the positive and the negative. So little Riskalyze example. You can see it just kind of pops up here. We'll get started. We are going to go through a few of these things that aren't going to drive the result fairly quickly. Say retirement, there's some comments you can add. Here's the major thing though, total investment account. If the market's down 10% and you have $10,000, it's not very painful. No one likes to lose $1,000, but it happens. If you got $1 million, 10% feels a lot more painful. That's $100,000. So we'll use $1 million. Again, just say this client has $1 million. It's a total investment amount. And we'll go next. We're not going to put in any birthday to retirement age. We'll give it a little positive for now because all of our clients are positive about the market and they're all confident. So here's where the scoring starts. So basically you take the slider and start moving it across. Now you can use this a couple of different ways. So you got, if you're interested in the chance at gaining, that's sort of more of your maximum result expectation. The red number is in dollars. That's the risk you're taking for any 6 month. Again, this is a 6 month rolling window. For any 6 month period, this is where you'd be. And then in the white box, it kind of gives you the average annual return of a portfolio like this. So you basically move this slider wherever you think you're comfortable. And again, this is a subjective thing. There's no right answer. So you move it around and you say, well, maybe you dial it in by, I just need 5%. Maybe you have a financial plan with us and 5% was the number. And I'm going to go 5.01 because I can't quite dial that exactly in. And then you go next. And it's going to ask you a couple of questions. So market drop quickly by $72,000. What would you do? Stay invested or sell and reduce risk? Well, hopefully you'll stay invested, but this is your choice. Stay invested. Then
Adam, real quick, while you're going
Chris.
through this, talk a little bit about how we help clients understand exactly what they're doing when they're asking or when they're answering these questions. We've always sort of framed this for clients that have used this tool as more like an optometrist exam, where you're selecting between a couple of things that are probably pretty close, but you just want to choose whichever one's better. And the whole concept here is that this software is supposed to help you dial up what your risk preferences are, right?
Yeah, that first slider kind of picks your sort of your starting point, your it defines your moat. Like I think I'm about within this range. And then these questions, and just if you've had an eye exam done, by the time you get to the end of the eye exam, you're not really sure if A or B is, I'm not sure if left or right is clear. They both look clear at this point. So again, there's no right answer. It's just designed to get you in a general area and then kind of fine tune that area. And we'll show you again. So let's just say, on the left is a potential gain of a certain number that could lose up to a certain number, or on the right is a certain gain. So we'd rather have that certain gain of 20,000. Well, 12,000, the next question, it drops it to 12.5. Well, maybe that's not enough. So I need to go back to A. And then, I go back to A again. So I'm just going to click through this. Again, this is just an example. And when you get through a couple of these, it calculates a risk number. So it's calculating ours right now. And we ended up at a 42, which basically says over a 6-month period, we could possibly make $122,000 on $1 million, but we also could be down basically call it $75,000. So the 42, Jason or Kyle, you want to explain a little bit where that 42 comes from and how it relates to maybe other investments?
Yeah, I'll take that. I'll actually add a little bit too on the dollar amounts there. And what we're looking at here is in our industry, a lot of times, going back, 15 years, it used to be, are you an aggressive investor? Are you moderate growth? Are you moderate growth in income? And these terms that people throw around in the industry that we have to essentially categorize accounts or categorize clients in. And everybody has a different definition of, aggressive or conservative or moderate. And so with this software, it allows us, in conjunction with the financial plan too, but it allows us to actually put a threshold or a feeling on that number and what that feels like in returns and experience versus just a word. And so the 42 number comes into play where think of it essentially as a 75, and I call it the speedometer test. So obviously the bigger the number, the more aggressive the account or the more, fuel to the fire. So 75 would be up kind of like your S&P 500. And, essentially 1% or a number one would be a 1. And so when you're coming in here with a number like 42, you're really looking at more of along the lines of a typical balanced portfolio, probably around that 50-50 mix between, say, equities and fixed income. And so that's kind of what allows us to do. Nothing when clients go through this is permanent. We don't get notified of your score and immediately go rebalance your portfolio and change your investments. But with new clients, it allows us to establish what that means and make sure we're on the same page on what that feel for you is and what to expect in a market scenario. And it also allows us to reference it in meetings going forward that, this is your 6-month range. And maybe that's, changes over time too. I know we've talked about that a little bit recently. A client saying, should we be rebalancing? This was painful this time. Should I have less risk? And so sometimes it helps to kind of revisit these numbers and do this, test again. It may have been different than 5 years ago for you. Like Adam mentioned before, with portfolios growing, the dollars are more real when the percentages are smaller. So,
Kyle, there to piggyback on that. I mean, as you mentioned, so long we were trained using words like aggressive and conservative,
right.
And where I really think it helps to quantify. And for a little note on that Riskalyze, it is on a score of 0 to 100, and so it's intentional that their marketing uses it to look like a speed limit sign, as we know that the higher the number goes, the more risk that we're taking. But where I like to use it, especially in the financial planning, I could talk to 10 different clients and all 10 clients say they're conservative, and
right.
We all know that all 10 are actually different. Every person's version of conservative or aggressive is all dependent upon their investments that they've been through, life experience, education, everything can affect that.
We've all had
word.
the aggressive client that comes back at a 6.
Exactly. So one person's conservative, we cannot take that just as their word. We really need to kind of quantify that. What does conservative mean to them? What does aggressive mean to them? And so really kind of showing that out in a scenario, because everyone realizes that they want to average a 5% rate of return, a 6% rate of return. Right now, we don't live in a world where you can get that risk-free. And so if a person needs to achieve 5 to 6% because their cash flows in the future dictate that, then that way we can show them, here's what we need to be able to tolerate, or what you need to be able to tolerate temporarily on the downside in order to achieve that average. Is that something that is feasible or realistic for you?
And the key to that too is, I know Adam mentioned it, but I don't know if everybody would have caught it, is the 6-month window, right? So that's not, at any given day, it'll never be more or less than this dollar amount. And again, it's a 95% probability. It's essentially the old, bell-shaped curve. But over a 6-month period of time, this is kind of the range we would anticipate your portfolio potentially fluctuating. Not all the time, not every time, but 95% of the time, within a 6-month rolling window, that's kind of what you would anticipate to see, based on historical market returns.
Because where do most investors measure from?
The bottom and top.
That's right.
The barometer is always the highest it's
whatever
ever
the
been.
most money you've ever had at any given point, then everything from there is down.
Yep.
And that's what, again, it's a 6-month window. So say, 2 months into the year, you're down 10%. You're not really down 10. You got to take the previous 4 months as well. So again, and I think another thing, just as a practice habit, I know we all take clients on, and when you're a Strong Valley client, when we take a client on, I mean, we're taking that client on, we're hoping that's, basically for life. I mean, we always say 10, 15, 20 years or more. So in order for us to do good for you, we have to have, we have to have a similar understanding. And that's where the expectation thing comes in. And sometimes it's just it's just a check for us that hey, we talked about what you want, and we think we're on the same page. But like I said, then the guy who, or the gal who we've talked to, or the family that has talked about, they really need to earn 7.5%, 8% a year. They're very aggressive. And then they come back at a 6.
Right.
And you're like, okay, we got something off here. So just defining expectations and setting up a positive relationship that we know we can deliver for and maintain for a long time, because our goal is to deliver for people, to make them happy.
We have this set up on the website too, where folks can get to it directly, right?
Yeah, it's at strongvalley.com /risk. And again, like we mentioned before, taking the survey and doing your risk score doesn't change your account or portfolio.
Mm-hmm.
It just lets us know that you've taken another test on it, if you will, and then allows us to discuss it in further detail. And again, if it's someone who may not be a client but just interested, we can always schedule a call to walk you through that and what it means and unpack it as well. And I'll rephrase that: strongvalley.com /risk. So
I was going to say that's a nitnoid item, but we need to get that in there.
Yeah.
And so Adam, not click by click, but what happens? Somebody goes to strongvalley.com /risk. They go through the process, all the clicks that you just went through. It forwards that on to us.
Yep.
And then where do we go from there?
And then we can reach out to them. Obviously, if it's already a client, we have an idea of how they're invested, and if it's significantly different, we need to have a conversation there. If it's similar, it kind of reaffirms what they're doing, and of course we can still talk about it. If it's a newer person, then yeah, we're happy to reach out to you and see if we're going to Strong Valley is a fit.
The benefit too, Adam, that comes up on that sometimes. Sorry, Chris, was that some people will submit a number and finish it, and that wasn't right, or that didn't feel right.
Sure.
That allows us to conversate the time to have that conversation, and we can walk through that again with you, and maybe restructure some of the questions and put it in terms that we're familiar with you, and show you that number and come up with a difference. So it's nothing permanent, doesn't set anything in stone or make any impact or change. It just allows us to kind of gauge where you really feel you're at and what makes sense for your accounts.
The only thing I was going to mention is that current clients have seen that sort of speed limit sign in their quarterly reports.
Correct.
So it's already reported in there as to how, what the current investments, how they screen and what their number is. But if clients want to complete that for themselves, then it gives them an idea that how they answered the questionnaire versus how the investments are currently positioned.
Right.
And just like anything, I mean, we try to be custom and flexible to all clients. I mean, some people have no interest in Riskalyze. They know exactly where they want to be, or they're comfortable with how we're handling it. And other people, it'll help a lot. So it's not a one size fits all. It's best practices and try to make sure, again, everyone's comfortable, and we're going to keep you happy and maintain a relationship for a really long time. So if nothing else on Riskalyze, let's talk a little bit about a Wrapup and kind of. I think it's a good practice for us, and I'm sure everybody wants to hear. I mean, if you're going to make predictions, this is my biggest gripe about the internet. Everyone loves to make predictions, but then you never have to own up to them. So talk about what we said last time in the roundtable. For those who listened, probably remember, and those who didn't, we'll recap it. But basically, we were talking about by year end that we thought we'd see inflation kind of hit a peak and come down around, I think we said 4 or 5%. That's, again, this is not just, our crystal ball. This is experts we listen to and following this every day. And then I think we talked about potential rate hikes, maybe fewer than are priced in, provided we do get this inflation move. And so we've had a little bit of that. Inflation has just started to tick down. Definitely not the 4 or 5% range, but I think what they say on some of those on some of the shows, we'd label that mostly correct or somewhat correct. we got a little bit of it right, but we're not at year end either. Anything new predictions? Anything you guys think for the year end? Again, it doesn't have to be extremely specific, just general direction of the market.
Well, one thing that did surprise me, and I think this is a big effect to the inflation numbers, is what we're seeing with oil prices. I don't think anyone, our last call, I don't know what oil was trading at, but I know it was well over 100. It might have been closer to about 120. I don't think anyone really predicted that with what's going on in Ukraine and what we're seeing with the rest of the inflation, that oil would come down to where it is now. I don't know what's trading at today, but I think it's right around 90. So that did surprise
87.
me. I think that's the fears of potentially economy slowing down globally. But that was definitely something that I was surprised by. I hate calling the market, but I'll put a prediction out there that, I was reading an article, and it's always nice to have history and data on your side. And it was saying that going back to World War II, anytime the stock market has retraced over half of its losses for the year, then it's never gone on to make a new low. And so hopefully not jinxing anything there, but that would
Don't
then
be
say,
that guy.
That would say that June, if the data would hold and the history would hold, then that means June would be the low. So I'm gonna put that prediction out there that June holds the low for the year.
Yeah, so the inflation, we probably don't get to 4 or 5% by the end of the year, unfortunately. But as long as we continue that direction, I'm hearing that, maybe that takes till mid-23 now. It's and like Chris mentioned, energy is such a huge driver of that number. I mean, it's obviously a factor for all of us or most of us driving, gas-powered vehicles, but it is such a big part of the inflation number. And there's so many other components that are important to the average, the average investor, the average American. But energy does drive a lot of it.
Well, that also ties into one of the other components you mentioned was the housing market, right? And so we talked about interest rates going up over the next, rest of this year and trying to get up to that target range of near 3.5%. Probably going to bring those numbers down a little bit as far as the amount of the increase. I think most of the predictions now are around 50% that it'll be less than the 75 basis points in September on the next rate hike. But either way, as these rates go up, we're already starting to see it as people are getting priced out of, homes as far as, loans and what they're able to buy or qualify for because of how much the interest rates have changed. So I think one of the things you'll see is that there'll be a slowing down a little bit in the prices of the housing market, which will also help that inflation number come down as it catches up with the interest rate increases here. So a couple of my thoughts on it is I've told clients in meetings, so I guess I'm holding the fire on it, that I do think the market will be higher at the end of the year than it is now. I hope we make everything back. I'm not betting on that. And I also think that inflation will continue to come down. I don't know that we'll get to that 4 or 5 number either, but again, that was one of our catalysts for the returns in the market coming back, was kind of that slowing down, as we mentioned earlier, on inflation. I think that's what we're seeing.
Chris, stock idea that'll be up 50% by the end of the year?
Not going to happen. Not going to happen. Interesting though. We did have at least, and I think we're going to be in that position maybe here in the near future, inverted yield curve. So where short-term interest rates are nominally higher than intermediate or long-term interest rates. And that, even though we're seeing technology actually do pretty well, that's been a big part of the bounce back in June, July, and thus far in August. The big names, the Apples and the Amazons, those guys have those stocks have come back pretty strongly. Information technology is usually one of the worst sectors during an inverted yield curve period. Again, historically speaking. So best performers over that time typically are energy and materials, and followed by utilities, and then a couple other sectors that are probably not worth mentioning right now. But that's going to be interesting to see how long we stay inverted, where as the Fed continues to increase interest rates on the short end, And if, like Jason mentioned before, that the 10-year Treasury is actually about the same spot where it was, a few months ago, that's going to continue to get, worse and worse from the standpoint of the yield curve itself. So we'll see how long that ends up persisting, but it's very positive for certain parts of the market. And again, interestingly, it's not as good for technology. So I don't know. I'm a sort of an eternal optimist. I'm a believer that we're probably going to be considerably higher than we are right now at the end of the year. But there's too many factors to try to really smash it together and say here's what our case is.
All right. Well, I think we'll probably wrap it up there. We've taken a little bit of your time. I will say this: please do give us questions. I mean, we want to provide value to everybody who's listening. We want to know what people are thinking. It helps us dial in on the things you really want to hear. So whether that's calling us, sending us an email, website submission, texting, whatever can get the message across, and hopefully we can keep doing these and people find value in them. We really appreciate you joining us today, and we'll be back in Q4 and see how many of these things we hit right on.